This is Chapter 11 of Accounting 201, Corporate Reporting and Analysis. And I will review the highlighted learning objectives. First, we will look at the corporate form of organization. A corporation is an entity created by law, and it has most of the rights and privileges of a person, but its existence is separate from its owner. And it can be either publicly or privately held. Publicly held means it does sell stock to the public versus privately held, which means it does not sell stock to the public. This is what the corporate organization looks like. The ultimate control of a corporation is with the stockholders, but they elect a board of directors who in turn hire executives, and then the executives hire the other employees needed to run the organization. This shows the differences between authorized, issued, and outstanding stock. Authorized are the total number of shares that the corporation is legally allowed to sell. Issued are the stock that the corporation has sold, either directly or indirectly, and outstanding refers to the issued stock that is held by stockholders. So we have something called Treasury stock, which we'll look at later, which would not be included in the outstanding stock. We're going to look at different classes of stock: par value, no par value, and stated value. Stockholders' equity consists of two parts: paid-in capital or contributed capital, which is the cash or other assets that were received in exchange for stock, and retained earnings, which are the cumulative net earnings minus the dividends. So we'll look at corporate stock. This is par value stock sold at par value. So they issued 30,000 shares of $10 par value stock for $300,000. So in this example, we will debit cash and credit common stock par value for $300,000, which is the par value. This shows an example of selling par value stock at a premium. They sold $10 par value stock for $12 a share, so they received $360,000 in cash. You always credit the common stock par value account for the par value. The difference goes into an account called paid-in capital in excess of par value. This is what the stockholders' equity looks like after selling stock with a premium. Notice that we have the paid-in capital in excess of par, and the $300,000 refers to the 30,000 shares issued and outstanding at $10 a share. So there is a difference in the journal entry when recording no par value stock. There's no par value here, so whatever you sell it for is what you debit and credit the common stock account for, the same amount. Notice that this says no par value. Stated value stock is similar to par value stock. We just use the word stated value instead of par value. They issued 1,000 shares of $40 stated value stock for $50. So they issued it for more than the stated value. So we will have that paid-in capital in excess of stated value account. So debit cash for 1,000 times 50, credit common stock stated value for 1,000 times 40, and the difference is the paid-in capital in excess. We can also issue stock for non-cash assets. So here they received land that was valued at $105,000, and they issued 4,000 shares of $20 par value stock. So we debit land for the value of the land, $105,000. We credit common stock for 4,000 times 20, which is $80,000, and the difference goes into the paid-in capital and excess account. If stock is issued in exchange for the work of the promoters of the organization, we debit an account called organization expenses, and their work was valued at $12,000. They received 600 shares of $15 par value stock. So that amount goes into the common stock par value account, and the excess goes into the paid in capital and excess of par value account. Next, we will look at dividends. We have 3 important dates related to a dividend. The date of declaration, which is the date a liability is recorded. The date of record, which is the date that they determine who owns the stock. And the date of payment, which is the date that the dividend payment is made. In this example, on January 9th, the Board of Directors declared a $1 per share dividend on 5,000 shares of stock. So that's 5,000 shares times $1. We reduce retained earnings for that amount, and we credit the common dividend payable, which is a liability. On the date of record, no journal entry is recorded. On the date of payment, we simply debit that payable and we credit cash. Instead of a cash dividend, a company can issue stock dividends. So they're issuing additional shares of stock. And a stock dividend is separated into either a small stock dividend, which is less than or equal to 25% of the outstanding shares, or a large stock dividend, which is greater than 25%. The first example shows a small stock dividend. A small stock dividend is recorded at the market value of the shares. So here they had 10,000 shares, $10 par value. They're issuing a 10% stock dividend, and the market price is $15. So how many shares did they issue? 10,000 times 10%, that means they issued 1,000 shares, and we multiply that by the market rate to get 15,000. So we debit retained earnings for that amount. We credit the common stock dividend distributable for the par value. So 1,000 times 10, which is 10,000, and the difference goes into the paid in capital and excess account. When the stock dividend is distributed, we reduce that distributable account, so get a zero balance in that account, and we put the amount into the common stock account. A large stock dividend is greater than 25%, and with a large stock dividend, you record it at the par value. So here we have 10,000 shares of $10 par value stock, and we're declaring a 30% stock dividend. So 10,000 shares times 30% means we'll issue 3,000 shares. Multiply that by the $10 par value to get 30,000. So debit retained earnings for that amount and credit the common stock dividend distributable account. On the date of payment, then, we would debit this account and credit the common stock account. Now we will look at the differences between common and preferred. Now we will look at preferred stock. Preferred stockholders have special rights that give it priority over common stock in terms of dividend distributions and distribution of assets in case of liquidation. And the preferred stock can be either cumulative or non-cumulative. Cumulative means that the owners receive a right for unpaid dividends. So if a dividend is not declared, or if the dividend declared is not large enough, there can be what's called dividends in arrears, where that amount is owed to the preferred shareholders. If it's non-cumulative and a dividend isn't declared in a particular year, then the preferred shareholders are not owed that amount in the next year. We're looking at this example where we have 1,000 shares authorized of preferred stock and 50 shares issued and outstanding of $100 preferred stock. First of all, you have to do a computation similar to this. You have to take the number of preferred shares, multiply it by the par value, and then multiply it by their percentage. It will usually be stated as a percentage of the par value. The preferred shareholders are supposed to get $9,000 in this example. And it depends on if it's cumulative or non-cumulative, if they will get that amount depending on the amount that the board of directors declares. So in other words, if it's cumulative in any year with less than $9,000 declared dividends, it means that the preferred shareholders will have dividends in arrears. So 9,000 is the magic number we're looking at. In this example, the board of directors declared a $5,000 dividend in 2018 and a $42,000 dividend in 2019. So if it's cumulative, the first year, the preferred will get the whole $5,000, but they also are owed $4,000 because it's cumulative and they only declared a $5,000 dividend. So we have $4,000 in arrears, $5,000, the whole $5,000 is given to preferred, common doesn't get any. In the next year, 2019, they declared a $42,000 dividend. So first, for 2019, you want to pay back preferred the amount in arrears plus give them their $9,000. So in the second year, preferred will get the 9 plus 4, which is 13. And then common will get the remainder. If it's non-cumulative, in the first year, preferred will get their $5,000, but in the next year, there's no dividends in arrears. So in the next year, preferred will just get their $9,000 and then common will get the remainder. We will now look at treasury stock. So treasury stock represents shares of stock that a company has bought back. So they've gone to the open market and they've purchased back some of their own shares. So this means the shares outstanding will be less. This is the journal entry for treasury stock. If they purchased 1,000 shares in the open market for $11.50 per share, we will multiply 1,000 times $11.50, and that's how much we will debit treasury stock for, and then we'll credit cash. So we use something that's called the cost when looking at treasury stock. We do not look at the par value or the stated value. We simply look at our cost, what we paid for the treasury share. So now we're going to sell it, and when we sell it again, we're looking at the difference between what we paid for that treasury stock and what we sold it for. Here, in this example, we sold it for the same amount we paid for it. So we'll simply debit cash and credit the treasury stock for 100 times $11.50. But if we sell it for more than our cost, we will have a paid-in capital account. So remember, we paid $11.50. Here we're going to sell 400 shares. So we're looking at the difference between what we paid and what we sold it for. We sold it for 50 cents more than we paid. So 50 cents times 400 is $200. So we credit the paid-in capital treasury stock for that amount, debit cash for the amount of cash we received, and take it out of the treasury stock at the same rate we put it in at, which was $11.50 a share. If we sell it for less than our cost, we're going to do the same computation. Here we sold it for 10. Remember, we paid $11.50. So the cash received will be the 500 times 10. So we're going to debit cash. And we have to take it out of the treasury stock at $11.50. So that's the $57.50, 500 times $11.50. The difference is $750. So remember in the previous slide, we have a credit balance in the paid-in capital Treasury stock account of $200. So when we sell it for less than what we paid for it, we first have to reduce that account. We can only reduce it to a zero balance. Any remainder after that has to be debited to reduce retained earnings. So you have to do a side calculation and determine how much you have in the paid-in capital Treasury stock account. If the balance is not great enough for the deficit, the amount you sold it for less than what you paid for it, then you have to take the remainder out of retained earnings. So we will now look at retained earnings. Retained earnings is the cumulative amount of net income or loss less any dividends declared. And there are some restrictions on retained earnings, some legal restrictions and some contractual restrictions. Then we also have something called prior period adjustments, which are corrections of errors from past financial statements. So it could be a mathematical error or some improper accounting or that we missed something. So in that case, we will have to go back and make a prior period adjustment. And it will always be net of tax. So in this example, they incorrectly recorded the cost of land and they're making a correction of that. So you have to make a prior period adjustment. And this shows the statement of stockholders' equity, and it's more inclusive than the statement of retained earnings. And you can see the columns here. So the common shares, the common stock amount. So these are the number of shares. This is the dollar amount. Our retained earnings, so beginning balance, add net income, subtract dividends. This is our total equity. This concludes the lecture for Chapter 11. I hope you learned a lot watching this video.